Have you ever seen a company's stock price just shoot for the moon and thought to yourself, wait a minute, is it really worth that much? Or maybe the opposite, it plummets and you wonder, is there a hidden bargain here? That's the billion-dollar question, right? And today, we're going to pull back the curtain and demystify the whole world of corporate valuation to find some answers.
Because that's what it all comes down to, isn't it? I mean, the stock market flashes a price at us every single second. But let's be honest, that price is often driven by hype, by fear, by the latest headline. So how do we cut through all that noise and figure out what a company is fundamentally worth? Well, that's exactly what we're here to unpack.
All right, to even start unraveling this mystery, we've got to begin with the golden rule of valuation. This is the one concept that, once you get it, changes how you see everything. It's the critical difference between price and value. See, price is what you pay, but value is what you actually get.
In this slide, it just lays out that tug of war perfectly. On the left, you've got price. Honestly, think of it as the market's mood ring. It can be swayed by a single tweet or a sudden panic, which leads to these wild emotional swings. But value, over on the right, that's the anchor. It's a calculated estimate based on a company's real, tangible ability to generate cold, hard cash over the long haul. Understanding this gap, that's the whole game. It's how smart investors try to avoid bubbles and spot those rare, undervalued gems.
Okay, so if our big goal is to find that intrinsic value, how in the world do we actually do it? Well, this brings us to a fork in the road, where you've got two pretty distinct philosophies for estimating a company's true worth. Let's think of these as two different detective methods. The first one, intrinsic valuation, is like a deep forensic analysis of the company itself. You're examining its DNA, right? Determining its worth from the inside out. The second method, relative valuation, that's more like interviewing all the neighbors to see how this company stacks up against its peers on the block. So let's start with that forensic analysis, the inward-looking approach. People often think of this as the more scientific method. And the gold standard here is something called a discounted cash flow, or DCF. Now, don't worry, we're not going to get bogged down in spreadsheets. We're just going to focus on the two core ingredients that make this whole thing work. First up, cash flow. And this is so key. For just a minute, forget about reported profits. Think about your own finances. Your salary might be your revenue, but your real cash flow is what's left after you've paid your rent, your bills, your groceries. It's the money you can actually use. For a company, it is exactly the same. It's the real cash that powers growth and returns. It's the fuel for the engine.
Okay, ingredient number 2 is the discount rate. Now, this sounds way more complicated than it is. The idea is simple. $1 today is worth more than $1 next year. Why? Because you could invest that dollar today and earn something on it, right? The discount rate is just a way to account for that and for risk. So a riskier company gets a higher discount rate, which means its future cash is worth less in today's terms. Simple as that.
So when you boil it all down, a DCF analysis is just this. It's all about projecting a company's cash flows way out into the future, and then using that discount rate to translate all that future money back into a single number that represents its value today. That final number, that's your estimate of its intrinsic value. Okay, so that was the deep forensic dive. Now let's switch gears to our second detective method, interviewing the neighbors. This is called relative valuation, and honestly, the easiest way to get it is to think about pricing a house. You don't just analyze the bricks and mortar of your own house. You look at what similar houses on the same street recently sold for. This approach uses something called a valuation multiple. It's just a simple ratio. The most famous one you probably heard of is the price to earnings, or PE ratio. And it's basically asking a very direct question. For every single dollar this company earns, how many dollars is the market willing to pay for it right now? And this slide gives you a perfect little snapshot of how this works. You just look at a few comparable companies, check out their PE ratios, and find an industry average. In this case, it's 29. So if the company you're analyzing has, say, $10 million in earnings, you could make a pretty good argument that it should be worth around $290 million. It's a really powerful shortcut that anchors your valuation in what's actually happening in the market today. So we have these two approaches that seem pretty scientific, right? One's based on cash flows, the other's based on market data. But here's the twist, and this is probably the most important part of this whole thing. Both of them are built on a foundation of human judgment. This is where the science of valuation really becomes an art.
You know, every single input requires an assumption. For that DCF model, what's your story about the company's future growth? And for relative valuation, what's your story about why this company deserves to be valued higher or maybe lower than its peers? The numbers, they're just the vocabulary. The story you build with them, that's what gives them meaning.
And that's exactly why we need to just bust these common myths right now. Valuation is never ever about finding one single precise number. And a super complex spreadsheet doesn't make a valuation better. In fact, it can just hide bad assumptions. The process of questioning your own story is often way more important than the final number you end up with.
So, if both methods have their own flaws, and they both rely on these subjective stories, are they useless? No, not at all. In fact, the real magic happens when you stop trying to pick one and you start using them together.
I mean, this slide lays it out perfectly. The DCF is so powerful because it's grounded in the business's fundamentals. But its big weakness? A tiny change in your assumption about the future can totally change the outcome. In relative valuation, it's great because it keeps you honest about what the market is thinking right now. But its fatal flaw is that the entire market could be wrong. And this brings us to the most crucial takeaway. Think of it like using both a microscope and a telescope. The DCF, that's your microscope. It lets you zoom way in and examine the company's internal workings in minute detail. Relative valuation, that's your telescope. It gives you that wide-angle view of where that company fits in the bigger market universe. You absolutely need both to get the full picture.
At the end of the day, understanding this framework moves you from just reacting to a price to actually analyzing a business. It gives you the power to look past that flashing ticker on the screen and ask the most important question of all. Am I looking at the temporary mood of the market, or am I looking at real, long-term, fundamental worth?